Okay, let's unpack this. Imagine, just for a moment, you're seeing all these signals, right? The market seems pretty convinced the Federal Reserve is getting ready to cut interest rates.
Yeah, the odds are high. Something like a 90% chance of a quarter-point cut pretty soon, maybe mid-September.
Exactly. And then maybe, another couple of cuts penciled in for next year.
Yeah.
So that sounds like good news, lower borrowing costs.
Right, suggesting the economy might be slowing down,
Yeah.
needs a bit of a boost.
But here's the paradox. At the very same time, long-term borrowing costs, think the 30-year U.S. Treasury yield, they've suddenly spiked. We're talking nearly 5%.
Wow. Levels we really haven't seen since, what, the 2008 financial crisis?
Precisely. It feels like a glaring contradiction. Why price in Fed cuts while long-term rates are soaring? So this deep dive is all about figuring that out. What's the market trying to tell us? And, what does it mean for your financial decisions?
Well, what's fascinating here is this might not actually be a sign the system is broken or malfunctioning. Not at all. It could be the market signaling something much bigger. A profound shift, maybe a new financial reality where other forces are starting to push back against the central banks, forces that might be even more powerful now.
Okay, other forces. So,
Yeah.
where does this split come from? Because the Fed controls rates, right?
Well, yes and no. Here's where it gets really interesting. The Fed directly controls the overnight lending rate, that really short-term stuff.
Right.
But those longer-term Treasury yields, they aren't set by the Fed. They're determined by the market. It's like a collective forecast, everyone weighing in on the future.
So what goes into that forecast then? What makes up that long-term yield?
Fundamentally, it's two main things. First, yes, the market's guess about where the Fed will take those short-term rates over time. That's definitely part of it.
Okay.
But second, and this seems crucial right now, there's a risk premium. It's called the term premium.
The term premium. That sounds like where the action is, given this divergence we're seeing.
Exactly. And a huge driver behind that rising term premium and rising long-term yields overall is, well, you could call it the invisible hand of fiscal policy.
Fiscal policy. So government spending and debt.
Precisely. It's the sheer overwhelming supply of new U.S. government debt hitting the market.
Mm.
The government needs to fund its spending, its deficits, right? And it does that by issuing Treasury bonds.
And the scale is big.
Immense. Just in the last 5 weeks or so, something like over $200 billion in new debt has been issued.
Wow.
And if you just connect that to basic economics 101, more supply of anything usually pushes the price down.
And with bonds, lower price means higher yield.
Bingo. They move in opposite directions. So this flood of new supply is mechanically, pushing yields higher. For years, people just assumed demand for treasuries was, well, infinite, unshakable.
Right. The ultimate safe haven.
But the sheer volume now, it's really testing those assumptions. The market's starting to demand a higher price, which means a higher yield, just to absorb it all. It's like the market is saying, hey, there's a limit and we need more compensation for taking on this much debt.
Okay, that makes sense on the supply side. But let's go back to that term premium you mentioned. You said it's a risk component. Has it always been this significant factor? I seem to remember times after 2008 when it was really low, maybe even negative.
You're absolutely right. That term premium is basically the extra return investors demand for the risk of holding a bond for, say, 30 years instead of just overnight. It's compensation for uncertainty, future inflation, future Fed policy changes, all that stuff way down the road.
Okay.
And for almost a decade after the '08 crisis, because central banks were buying up so many bonds, quantitative easing, or QE, they artificially suppressed that premium.
QE. Right.
Yeah. It pushed the term premium down, sometimes even below zero. So investors were essentially paying for the safety of long-term government debt, which is, well, not normal. It distorted things.
But that's clearly not happening now. It's flipped.
Dramatically. Today, the 10-year term premium is near its highest level since 2014. We've got data from the San Francisco Fed backing this up. The latest estimate puts the 10-year premium at about 1.29%.
And how does that compare?
Well, just a year ago, it was around 0.77%. So that's a pretty significant jump.
Okay, can you break down the yield? Like how much is expectations versus this premium now?
Yeah, let's look at the 10-year Treasury. A year ago, September 2024, the yield was about 3.84%. Back then, the market expected future short-term rates to average around 3.07%. That left the term premium at 0.77%.
Got it.
Now, fast forward to the most recent data, September 2025. The 10-year yield is up to 4.29%. But here's the kicker. The market's expectation for future short-term rates actually dips slightly to about 3.03%.
So the expectation part went down.
Right. but the term premium surged to 1.29%.
Wow. So virtually the entire increase in the 10-year yield over the past year is because of that rising risk premium.
Exactly. That's what's so fascinating. It tells us the market's focus has really shifted. It's less about predicting the Fed's next couple of moves and much more about these longer-term risks. Fiscal dominance, the sustainability of government debt, the potential for stickier inflation.
So the market isn't broken, it's recalibrating, sending a warning about the fiscal path.
That's a great way to put it. It's signaling deep concern that the current fiscal trajectory might only be sustainable if we see more inflation down the line.
Okay, this is a huge shift for the U.S. market. But is it just happening here, or are we seeing similar pressures in other major economies, maybe some cautionary tales?
Oh, absolutely. This isn't just a U.S. story. Look at the United Kingdom, for example. It's quite a compelling case study.
What's happening there?
Well, the Bank of England, the BOE, has actually been cutting rates quite aggressively, 5 times in the past year, trying to stimulate their economy.
Okay, so they are easing policy.
They are. But despite that, the yield on their 30-year government bond, they call them gilts, has soared to over 5.7%.
5.7%, that's high.
It is. It's the highest it's been since April 1998. And what's really telling is how high it is compared to other G7 countries. It suggests a specific loss of confidence in the UK's fiscal situation.
So the market's basically saying, we don't care that you're cutting short-term rates. We're worried about your long-term finances and inflation.
That seems to be the message. The market apparently believes the BOE can't really cut rates effectively without stoking inflation, given the government's spending plans. It's like the bond market is overriding the central bank's intentions.
That's a powerful dynamic. And if we're talking about extreme central bank action, Japan is always the classic example, right? Decades of fighting deflation with QE, zero rates.
The ultimate case study in central bank dominance, for sure.
So what's happening there? Is Japan immune?
Not anymore, it seems. Even Japan's 30-year government bond yield has hit multi-decade highs, and their 10-year yield, it climbed to 1.61%. Now, that might sound low compared to the U.S. or U.K., but for Japan, that's a level people would have thought impossible just a few years back.
So even the Japanese bond market is stirring after all this time.
Exactly. And this raises a really important question. If even Japan, the market most suppressed by central bank action for decades, is seeing yields rise like this,
then no central bank is truly immune.
that's what it looks like. It signals this growing global rejection of super low yields, especially in the face of potential inflation and massive government debt. It feels like the symbolic end of an era, the era of artificial yield suppression.
Confirming that deficits do matter, and the price of government debt isn't just something central banks can dictate forever.
Precisely. The market is reasserting itself globally.
Okay, hearing all this rising long-term rates, despite potential cuts, fiscal worries, global shifts, it's easy to see why some people might shout, stagflation. Is that where we are? Let's maybe define that quickly first.
Right, good idea. Stagflation, just to be clear, is that nasty combination. You get high inflation, but at the same time, economic growth stagnates or stalls, and unemployment goes up.
Central banker's nightmare scenario.
Absolutely, because the usual tools don't work well. Raising rates to fight inflation kills growth even more. Cutting rates to boost growth fuels inflation. You're stuck.
So looking at the U.S. data now, are we actually in stagflation?
Let's break it down. Inflation first. Core inflation, so excluding food and energy, was 3.1% in July 2025, and it's ticking upwards. That's definitely above the Fed's 2% target, so check the box for high inflation.
Okay, one component down. What about stagnant growth or high unemployment?
Here, it's a bit more nuanced. Let's look at youth unemployment, ages 16 to 24. That was 10.8% in July 2025. Now, that is higher than it was a year before when it was 9.8%. So that does show a weak spot, definitely some softness in the labor market.
10.8% sounds pretty high. Is that stagflation level high?
Well, context is key here. While 10.8% is not great, it's not like a historical peak or anything. During the worst of the 2008-09 recession, youth unemployment hit over 19%.
Ah, okay. So it's elevated, showing weakness, but not necessarily cratering like in a deep recession.
Exactly. And overall, economic growth, while maybe not booming, still shows some resilience. So based purely on the current data, I wouldn't say the U.S. is in full-blown stagflation right now.
But the pressures are there.
Significant and growing stagflationary pressures. That feels like the right description. And these rising long-term yields we've been talking about, they are a huge signal of concern that these pressures could turn into the real deal, especially if fiscal policy doesn't get, more sustainable.
So the market isn't saying we're there, but we're worried we could get there.
I think that's it. It's pricing in a very real risk, a warning sign.
Okay, given this complex picture, these pressures, the market signals, the potential for rates to stay higher for longer, even if the Fed cuts, what does this mean for you, for an investor trying to navigate all this? Where do we look for guidance?
Well, luckily, we can look to some wisdom from some legendary investors who've thought deeply about these kinds of dynamics.
Who comes to mind?
Stanley Druckenmiller, for one. He famously said the best economist he knew was the stock market itself. He also talked about fiscal dominance, that exact situation where the central bank keeps rates low just to help the government finance its debt.
Which he warned had unthinkable consequences.
Right, and that's the dynamic being tested now. The market is questioning whether the Fed can keep printing money or keeping rates low without eventually debasing the currency or losing control of inflation.
So Druckenmiller points to the risk. What about someone like Ray Dalio?
Dalio's work on long-term debt cycles is incredibly relevant here. He observed that in the late stages of these cycles, central banks will often do whatever it takes. They'll print as much money as needed. But the crucial question he raises isn't if there will be enough money, but what its value will be.
And the rising yields and maybe the interest in things like gold are a response to that fear about value.
Exactly. It's a fear of devaluation, a search for things that hold value when faith in fiat currency or government bonds weakens.
And Paul Tudor Jones, he had some pretty direct advice, didn't he?
He did. Very clear playbook. He basically said, if the Fed seems relaxed or nonchalant about rising inflation, that's your signal. That's a green light, he said, to bet heavily on every inflation trade.
Like commodities, crypto, gold.
Commodities, crypto, gold, exactly. And looking at market action, it seems like many investors are taking that advice to heart. They're positioning for inflation to be stickier than maybe the Fed hopes.
It's interesting you mentioned gold again, because we're seeing gold prices rise, but nominal bond yields are also rising. Doesn't that contradict the usual relationship? Usually, higher yields make bonds more attractive relative to gold, which pays nothing.
That's an excellent point, and it seems confusing on the surface, but it actually makes perfect sense when you dig a bit deeper.
Okay, explain.
What's fascinating here is that gold isn't really driven by the nominal yield on a bond. It's driven by the real interest rate.
Real meaning, nominal yield minus inflation.
It's exactly. What's the bond yield after accounting for inflation eroding your purchasing power? When inflation is high, even if nominal yields are rising, your real return might still be low or even negative.
So if inflation is rising faster than nominal yields, the real yield is falling, making gold look better.
Precisely. If bonds aren't actually protecting your purchasing power because inflation is eating away at the return, then gold, as a tangible store of value, becomes much more appealing. We've seen this before, actually.
When?
Think back to the late 1970s or even the mid-2000s, like 2004 to 2006. Both were periods where inflation was a major concern. And in both periods, nominal bond yields and gold prices rose together.
Because investors lost faith in bonds providing a real return?
Yes, they demanded higher nominal yield to compensate for inflation, but they also bought gold as a hedge because they feared even those higher nominal yields wouldn't be enough. So gold rising today alongside nominal yields isn't weird. It's a classic sign the market is seriously worried about long-term inflation and potential currency devaluation. It is the inflation trade in action.
Okay, so let's try and tie this all together. We started with this puzzle. Expected Fed cuts, but soaring long-term rates.
Right.
And what we found is it's not really a puzzle or a broken market. It's more like a necessary correction, wouldn't you say, after years of central bank dominance.
I think so. It's driven largely by huge government deficits, forcing massive bond supply onto the market.
And the market is demanding a higher risk premium, that term premium to absorb it all, signaling worries about long-term fiscal health and inflation.
And we see echoes of this globally. In the UK, even in Japan. It's a worldwide market reassertion.
We also identified not full stagflation in the U.S., but definitely significant and growing stagflationary pressures. A clear warning sign.
A warning, yes. Not a guarantee, but a risk the market is pricing in.
And finally, that rising gold price alongside rising nominal yields. Not a paradox at all. It's a logical flight to real assets when inflation erodes the real return on bonds.
It's the market making that inflation trade Paul Tudor Jones talked about.
So if we connect this to the bigger picture for you, the listener, what's the main takeaway?
I think the key is to maybe shift your focus. For years, it was all about what will the Fed do next month? Now, perhaps the focus needs to be broader, longer term. Look at the fundamental forces. Fiscal policy, government debt, the resulting inflation risks.
Because the market is sending a very clear message there.
A profound message. Deficits matter. The price of debt isn't guaranteed anymore. Central banks might not have the same level of control they once did.
So maybe a final thought to leave everyone with. What could it really mean for your own long-term financial strategy if this trend continues? If the market keeps demanding higher and higher yields for government debt and central banks find their power to, well, manage the system keeps fading.
That's the multi-trillion-dollar question, isn't it? Something
Yeah.
to really reflect on.